Thinking about buying a rental property? Then you need to know my 5 pillars for evaluating the financials of a rental property. Hi, I'm Paula Flagg with Paula Flagg Homes, and in this video, I'm going to be discussing the 5 pillars of evaluating the profitability of a rental property. Now, the information I'm discussing in this video is for residential properties with 1 to 4 units that are being purchased as a buy and hold rental property. If you're interested in commercial properties, maybe something like office space, retail, or housing with 5 or more units, or you're interested in evaluating fix and flip properties, reach out to me and I can provide more information on those properties as well. The first thing you need to be clear about is why you want to buy an investment property. Do you need to use the cash flow from the property to pay your bills each month? Or is this purchase part of your long-term wealth strategy? I've found that most people currently have a primary source of income that covers their lifestyle expenses and are looking to build long-term wealth. The great thing about real estate is that there are several layers of growth built into the investment. I call them the 5 pillars of real estate investments. So if you're one of the many people looking to grow long-term wealth, you want to understand all of these, and by the end of this video, you will. So the 5 pillars are power of leverage, principal paydown, depreciation and tax deductions, cash flow, and market appreciation. And you thought it was just about cash flow, didn't you? So I'm going to be using an example of buying a $500,000 house with a 20% down payment. That's $100,000. And I'll take a look at what happens if you hold that property for 10 years. So let's get started with the first pillar, which is the power of leverage. Now, one advantage that real estate has over some other investments is the ability to purchase with leverage. For example, if you have $100,000, you could buy $100,000 worth of stock or a mutual fund. And if that stock appreciates at 8% per year, you'd make 8% on $100,000, which would be $8,000. Now, in real estate, you could take that $100,000, pay 20% down on a $500,000 house. The historical average of home appreciation is 4%, and you get that appreciation of the full value of the home, not just the cash you put down. So if the house appreciates at 4% a year, that would be $20,000. Now, if we compare these two investments side by side, the rate of return on your initial investment of $100,000 in the first year would be 8% on the stock market investment and 20% on the real estate investment. And this compounds every year, making the growth rate gap widen each year. Second pillar is the principal paydown. Now let's take a look at the payment breakdown for your investment property. Most payments will include principal, interest, tax, and insurance. The principal portion is the part of the payment that decreases the balance of the loan. And each month when you make a payment, the amount of equity you have in the property grows. And remember, this payment is being made with the tenant's rent money, not your personal income. Now, in our example, when you purchase the house, you'll have a mortgage balance of $400,000. Now, with the interest rate of 7.5%, in 10 years, the balance of that mortgage will be $347,000. That's a $53,000 increase in your equity. The third pillar is depreciation and tax deductions. So depreciation is probably one of the lesser known advantages of owning rental investment properties. One of the largest expenses any of us will have to pay in our lifetime is taxes. And if you aren't already working with a high quality CPA, I highly recommend that you start. Now, I'm not an accountant, so take this information to your CPA and figure out the best way to integrate it into your wealth strategy. Depreciation allows you to write off a portion of an asset over the course of what the IRS calls its useful life. It can be used for all types of things like cars, furniture, equipment, anything purchased for a business purpose. And the defined useful life of residential property is 27.5 years. So you can take the value of a rental property, excluding the land, divided by 27.5, and deduct that amount from your taxes every year for 27.5 years. So let's say the land value on that house is $200,000. So we'll be left with $300,000. And then what we're going to do is divide that by 27 and a half years. So for the annual amount, we're going to get $10,909. You can depreciate, which means write off $10,909 of your income each year, which means if you're in a 28% tax bracket, that saves you about $3,000 a year in taxes. Now, over 10 years, that's $109,000 of income you won't be paying taxes on, which will translate into roughly $30,000 of tax savings. For a rental property, you're also able to write off any repairs and updates you make to the property, mortgage interest, HOA and condo fees, management and agent fees, and any other expenses associated with the property. Now, these tax deductions are great at reducing the overall cost of repairs. So, if you're in the 28% tax bracket, it's the equivalent of having a 28% off coupon for all of your expenses. The biggest difference here is that several expenses are deductible for investment properties that are not deductible for your personal home, such as putting in updates and renovations, hardwood floors, or renovating a bathroom. And your HOA and condo dues are considered business expenses, so you're able to write those off as well. Now, for the fourth pillar, it's cash flow. It's the thing you're most familiar with. Cash flow, by its simplest definition, is the rent received minus expenses. And this could be where people can get into trouble, either by overestimating the rent that they'll receive or underestimating the expenses they will incur. Now, when it comes to projecting income, I always recommend that you do your analysis based on long-term tenant rates. I know over the last few years, many people have made a great deal of money with short-term rentals, also known as Airbnbs or VRBOs. However, short-term rentals come with additional levels of risk. Laws in an area can change with little to no warning. Consumer behaviors can shift, and it's important to understand that short-term rentals are part of the hospitality industry, not the housing industry. So people will always need a home, a place to live, but vacation rentals are discretionary and will be impacted more by economic conditions. For expenses, you need to account for your mortgage, which is the principal, interest, taxes, and insurance, and any association fees. You also need to plan for vacancies, repairs, and maintenance, and property management. A good rule of thumb is to plan for 10% vacancy, 10% repairs, and 10% of management annually. And depending on the condition of the property, you may need to plan for additional savings for capital expenditures on items like a roof or an HVAC system. So for most people, cash flow should be one of the least important factors at the time of purchase. And while you don't want to necessarily be losing money each month, building wealth happens over time. A property that may only cash flow $100 a month right now could cash flow $1,000 a month in 10 years. And since most of you aren't dependent on the cash flow to cover your expenses today, you can make great long-term investment choices based on growing your net worth with the other strategies I'm discussing, and the cash flow will follow. A colleague of mine purchased a 2-unit property in LaDroit Park about 20 years ago. At the time of purchase, the top unit rented for $950 and the bottom unit rented for $800. There wasn't much cash flow at the time, and actually one of my colleagues' investor buddies declined the opportunity to invest in this property with him, so Buddy didn't think that the cash flow was high enough. Today, the top unit rents for $3,250 and the bottom unit rents for $2,800. That's an increase of $4,300 per month, or over $51,000 a year. In our example, the house would cash flow $100 a month at purchase. At a conservative projection of 2% increase in rent annually, the house would have a monthly cash flow of just over $800 a month in 10 years. And the fifth pillar, market appreciation. So market value is the value of the home on an open market. That's what a buyer is willing to pay for the property at a given time. And market appreciation is the difference between what you paid for the property and what the market value is today. So the market value of a property will fluctuate over time. And because there are fluctuations in the market, it's important to approach your investments in real estate with a long-term strategy. It's very difficult to time the market. So if you only intend to hold a property for 1 to 3 years, you could find yourself in a part of the market cycle that's equal to the price that you paid for the house or less. Just as with cash flow, let time do the heavy lifting for you. I recommend preparing for at least a 7 to 10 year hold period. Historically, property values increase about 4% annually on average, and that's factoring in market ebbs and flows. Remember, the only people who lose money during down periods in a market are the people who sell. So it's important that you have reserve funds set aside to address any extended vacancies, repairs, or other challenges that could occur. So let's take a look at our example of the $500,000 house and the projected value in 10 years. If you purchase today for $500,000 at a 4% annual appreciation, the house would be worth $740,000. That's an increase of $240,000 over that 10-year period. Now, I know I just shared a lot of information and a lot of numbers with you in a very short period of time. So let's take a look at a summary of our example. So here we can see that the sales price is $500,000. The down payment of 20% is $100,000. And then we look at the ways that our equity has improved or increased. Principal paydown is $53,000 over the 10-year period. We took advantage of depreciation and was able to write off a portion of the house, which saved us over $30,000 in taxes. We accumulated over $50,000 in cash flow as those rents increased over the 10-year period. And we were able to take advantage of the annual market appreciation of 4%, which gave us an increased value of $240,000. So if we add all of that together, we have the net worth increase of $373,500. So the return on your initial investment is 374%. Now, as you can see, there are several ways to build wealth with your real estate investments through these 5 pillars. And there's so much information I want to share with you about the topic of real estate investing, but I'll have to wrap this video up now. So if you have any questions about this or any other real estate topic, please call me at 202-670-5880, and I'd be happy to help. Thank you for taking the time to watch this longer than normal video today. I hope it was helpful. And as always, thank you for choosing Paula Flagg Homes for all of your real estate needs.